learn something through it. So we really try to make this not just us teaching, but more of like a conversation in this. So, all right, just about to get it going.
All right, before he gets back, Carlin wanted to let you know about these folders. She's got tons of them, and you can use them for your clients, buyer or seller clients. And it's kind of got stuff in here, but there's a folder that you can put information in. And one of the things that we have for Aligned Home Loans is just information on mortgage debt. So if you want to use these flyers, we can, if you call Christy, she will be able to put your information in here, a picture of you and your information for you to give to clients. And this kind of lets them know about mortgage loan types. It's got different flyers on different mortgage things. So that could be something you can put in this folder for your agent. Okay, so if you want to get these folders, Carlin has them. Okay.
Cool. Yeah, I say let's jump into it. We're a few minutes after 10. So hello, everyone. Like I mentioned, I'm Travis Gardner. This is Linda Cunningham. We're with Aligned Home Loans. Just a quick little story on Aligned. We are 100% local here in town. Anyone who has ownership or works with Aligned, is based here in the Austin area. We are what's considered a mortgage broker. There's, in my opinion, there's maybe like 3 different categories of how a mortgage company can work. You have your traditional, like credit unions and banks that do their, hey, you need to share? Oh, that one's free or this one's free? Yep. So, as I was mentioning, there's a couple different ways that mortgage companies work. And, we've worked at a few of them. There's like the credit union style where they do everything in-house. There's big mortgage companies that do everything that just strictly focus on mortgages, and there's what's considered a mortgage broker. We're your loan officers. We work with your clients the entire time, but what we can do is go and shop maybe 20 to 30 different people who offer finances and find the best products, rates, and whatnot for your clients. We're not compensated on what loan type they get or what interest rate. We're just trying to find the best options for y'all. And we feel like this model provides a lot of flexibility and a lot of ways to get loans approved. So let's see here. Cool. So Linda, I'll let you introduce yourself.
All right. I just want to let you know a little bit about me. I have been in Houston for 38 years, and I just moved to Austin a year ago. So I'm new to Austin, and I joined Aligned Home Loans in November, and I'm really excited. That it's a great company, and it's awesome. So just a little bit about myself. I always like you to know more about me personally. I have 3 kids. And this is my oldest, Chrissy and Josh, and my 2 grandkids, Elijah and Ember. And then there's my middle daughter, Brooke and Michaela. They're together. And then my son, Ford and Emma. So those are my kids, and they're due in April for another grandson. So grandkids are an awesome part of my life. They're really good, and they all live in Austin. So that's what got me here. I wanted to see them. So my oldest lives in the Bee Cave area. My middle daughter lives 7135, like Franklin Park area. And then my son is in Georgetown. So they're all scattered in Austin. And so that's what got me here. But anyways, I love being active. I love hiking. Pickleball. If anyone's interested in pickleball, call me. Okay, it's fun.
That's your girl right there. Yeah, Linda's a pickleball champ.
Pickleball players. I'm a tennis player. I play golf. I'd like to really be outside and active. So those are the things I like to do, but I love the mortgage industry. I'm passionate about helping people get into a home, and I feel like with realtors, we're a team. We're a team to work with that client, especially first-time home buyers. I sometimes will cry at closing, going, "No," because we're working things out. So it's just a joy being a part of it. So I'd love to help any of your clients.
Absolutely. Yep. And as I mentioned, my name is Travis. These are my 2 twins, Chloe and Ben. They just turned 11 months yesterday, and that's my oldest, which is weird to say because she's only 2.5 years old, Julia. So I have 3 kids, 2 and under, and it's as wild as you probably think it is. It's just absolutely crazy. And this is my brother Trey. He's my main man. Trey has special needs, and he's the reason I'm very involved in the Special Olympics. It's kind of my personal passion. If you look real closely, you can see he won the Dance Master Award at some camp. I volunteer at Marbridge, which is a local organization here. He spent a week there at summer camp. So these are, we included these family photos. Number one, let you know, kind of, real human beings, but also like these are the reasons we do what we do. You'll know as being an agent, and we know as being a loan officer, sometimes it's a grind, sometimes it gets a little tough. And this is to kind of remind you of like the why of what we're doing to, kind of support our family. Had this been, 3 years ago, I might have included concert photos or maybe the golf course, but this is my life now. So real quickly today, what we're going to cover. And like I mentioned, if some of y'all just joined in, it's a very interactive class. If you have questions, examples, please stop us. Don't wait to the end. Let's talk about it. But basically, we're going to go over your role as an agent. Then we're going to jump in a little bit into like the math of what goes on behind the scenes on a mortgage loan. And then we're going to do a really high level overview of the loans. Like I mentioned, this class is not to make you a junior loan officer by the time it's over. It's just to give you a little bit of information and tidbits. So if your clients are talking mortgage terms, that, oh, I've heard that before, or I can kind of answer that, or at least direct them to, us, and maybe we can dive into it a little deeper. So first, your role as an agent. And I start with this slide first for a very, distinct reason. You may have noticed when clients call you, or when the clients start thinking like, hey, I want to buy a house. Typically, the first person they call is y'all, the agent, right? Now, we may be a little biased in saying that we think they should start with us to see how much they get approved, but typically that's not how it works. They get excited about a house, they start looking on Zillow or whatever, on Google, and they reach out to y'all to start looking. And, then they kind of like go backwards and get in touch with us to kind of get it approved. So, asking questions is a big part, assessing their needs, just gaining that trust. This is a very personal, I don't like to use the word transaction. It's almost like a journey that your clients are going to be on. So, developing that, relationship is big time, on our end and on your end. Talk about timelines, what they should expect. As the agent, you're almost like the captain of this transaction. Being able to control all the different things. You've got inspectors going on, you've got lenders, you've got the other, buyer or the seller's agent. So you've got a lot of control in this. If you have an opportunity to refer them to a lender that we would love that opportunity, but just advice for y'all, it's always great to have a relationship with your lender. Sometimes things get a little complicated and a little hairy. Real estate is just like life. Things can pop up and, crazy things can pop up. So it's nice to have that relationship with your lender. Identify any potential pitfalls. We'll dive into that a little bit more and setting some rules going forward. And some common questions we think are, to ask is certainly, have you spoken to a lender? A lot of times they haven't, so you'd be able to do a referral. If they have spoken to a lender, we're not saying we're the only great lenders in town. We'd love to earn your business. But if they mention like, oh, I'm working with, a credit union, or I'm working with Rocket Mortgage, I'm not here to, down on those other lenders, but I'm saying sometimes other places are more 8 to 5 establishments, or it can be hard to get people on the phone. And as you'll know, real estate is almost like a 24/7 job. People want to look at houses on the weekend, or maybe you have lending questions on a Saturday and Sunday. We certainly have personal lives, but we don't work just 8 to 5. We're here to help y'all out at any time. Great question to ask, when they come to you for that initial consultation is, do you have earnest option and inspection costs? A lot of times people don't understand what those upfront fees are, and they may come to you and be like, oh, I've got a couple $100 in my savings account. Well, you're going to need these upfront, things to get moving forward. Now, it doesn't necessarily have to be your own money. It can maybe be a gift from a family member. And we're going to talk about different programs to help with down payment in a little bit. But that's just always a good question to ask if they got those initial, funds available. The next two questions, your price range and how much your monthly payment is, those are kind of go hand in hand. One of the first questions me and Linda always ask is, what are you looking for in a monthly payment? Sometimes people want to know like, hey, what's my maximum approval? Well, and we can try to tell you that, but a lot of times you may not want that monthly payment that comes with your maximum approval, right? So, I always like to say, hey, is there a price range that you feel comfortable in? And then that kind of tells us where they may need to be shopping as far as a price point. If they tell you like, oh yeah, I need a 5-bedroom house in Austin, but I want a monthly payment of $1,500. We might not be on the same page here, and we need to kind of, like redial that in. And lastly, what time frame are you looking to purchase? I always like to know, are you looking later on in the year, or hey, is my lease due in 2 months? One time I had someone call me on a Saturday and say, I need to be out of my apartment by Friday in 6 days. Like, well, that's pretty much going to be tough. So readjusting like what the expectations and the time frame are. And then, these are rules that like we feel like, just kind of need to be established. Rules might be a little, harsh of a word, but, these are just things to kind of set to make the transaction smoother and just an enjoyable process. Keep in mind, like this is probably the largest financial transaction that your buyers have ever done. So they may be a little scared, a little nervous. And so it's good to kind of lay some groundwork that, number one is like, let's keep the grand prize in mind at all times. And that's becoming a homeowner, right? It does require a little bit of work. We try to make it as easy as possible for your clients, but there is some responsibility on everyone's part that's, in this to make it successful. And number one is definitely be responsive to our needs. When you go under contract for a house, you have a legal deadline of when we're trying to close. And we're going to need things from you, the clients and whatnot. And so if they're not turning in things in on a timely basis, well, then we can start missing closing. And nobody wants to miss a closing date, right? Like that just is not where we're trying to go with this, but just reminding people that, if their lender asks you for something, it's because they need it and we're trying to get to the finish line. We list this other stuff because these things can come up in casual conversation when you're just speaking to your client. Like you have your initial consultation and they say, oh, well, after we get done meeting, I'm about to go over to Honda and buy me a new vehicle. Well, that should trigger something to be like, hey, before you do that, you may want to speak to your lender about opening up new debt. Right. So typically we want to keep everything as like, as stale as possible, meaning like don't open up new credit, don't go get a new car. Let's get you in that house first and then go from there. That doesn't mean it can't be done, but let's at least have that conversation before you go do it and maybe, cause something to be harder than it needs to be. This one, number 3, comes up all the time. Man, I got one with Chad right now. Chad is, the co-owner of the company. We asked about, oh, hey, that earnest money and that, down payment, where's it coming from? Country guy I'm working with, funny as can be. Oh, I don't trust banks. I got my safe in the house and, I got $20,000 in there. Well, cash is not king when it comes to mortgages, right? Cash is very difficult to work with. That doesn't mean it can't be used, but there's a strategy and a way that we, have to do it. And we can at least give you some advice or give the client some advice on how we can potentially make that happen. Typically, it's a little bit of a waiting period. But if you ever hear someone talk about cash and wanting to use it, that should just trigger something like, hey, let's talk to the lender and figure out how we can use that. It sounds straightforward, but my goodness, don't quit your job until the loan has closed and funded. It happens. And, we try to bring these things up to, people, and you would think it's common sense, but I'll give you a quick example. I was helping someone last year who was a teacher and she was pregnant, and she, we're going through the process. We're under contract for a home, about a week before closing. As lenders, we have to verify you're still working there. Like that's part of the final approval process. Well, we went to go do that and their HR team says, oh no, she didn't re-sign her contract. She's taking off because she's pregnant. And teachers sign like normally a yearly contract to keep going. Well, in our world, that means she just quit her job, kind of thing. So luckily we were able to like re-scramble and have her re-sign the contract. And once the house closed, what she decides to do with her life, that's her business, right? Where at least we got to the finish line. But just if someone starts talking about job changes or whatnot, when they're in the middle of a mortgage transaction, hey, let's talk about that before you make any big decisions. And then, keeping you in the loop every step of the way. We try to do that as your lender. We want you to understand where we're at in the process, the pre-approval, when we're under contract. We try to do a really good job to making sure you understand. But also, it's the client's responsibility to keep, all of us in the loop of what's going on in their life, and as we're trying to get them pre-approved to the finish line. Linda, I'll pass it to you.
All right. Okay, mortgage payments. That's really important that we let them know what that monthly payment's going to look like so they feel really good about it. And this is kind of the breakdown for it. PITI is principal, interest, taxes, and insurance. That's what that means. And so we're giving an example of what payment would breakdown would be. Let's say the home value is $400,000, the loan amount's 388, interest rate's at 7%, and the tax rate is at 3%. Okay, so what makes up the payment is principal and interest. So based off of the loan amount and the tax rate, we come up with the principal and interest. Okay, so that's your PI. Then taxes. Now taxes are different with every different house. So it depends on the rate. Right now it's 3%. So based off 3%, that's $12,000 divided by 12 months makes it $1,000 a month. Okay, and we have to add that to the principal and interest. Okay, so there's their taxes. Insurance, you need homeowners insurance. So we're breaking it down. We're thinking it's $1,200 a year. So we've broken it down to 100. So it's 100 per month for insurance. We're adding these together. If there's an HOA, we have to calculate the HOA dues in the monthly payment, but it will not be part of your mortgage. With HOAs, you always pay that every year to the HOA, but we have to calculate that for our DTI. In this example, there's no HOA dues. And then PMI, private mortgage insurance. So with the mortgage insurance, it's just calculated based off of the loan amount, and we have to include that. That means the person's only putting down, how much that is?
3%.
3%.
Yep.
So you have PMI. If they put 20% down, you don't have to, with conventional. Okay, so there's the PMI. And then all that totals this $3,859 per month. So this is kind of a breakdown we will send the clients. We will show them, okay, this is it. This is what your monthly payment is. If they're like, oh my gosh, $3,800, I can't afford that. We can adjust things. We can play with the numbers. So let's say they say $3,500 is really good. What we could do is say, hey, let's put more down. That'll make the loan amount less. Interest rate, we can maybe pay a point or something for a lower interest rate, or the home value. They haven't been shopping yet. Let's say, okay, 400 is a little too much. Let's move it down. We'll play with the numbers and say 375 is a better purchase price for you to get it to where we want that monthly payment. So at the very beginning, before they even go shopping, we try and show them this of what a $400,000 value house looks like so they feel good. And there's no shocks or whatever. So once they go shopping and they find a house, they're like, oh my gosh, Linda, we found a house. We love it. Here's the address. We pull the address. We run the numbers. We figure out what the taxes will be or the insurance. I'll even call an insurance agent and say, hey, what will it be? And we'll give them a really good estimate of that house. So before they put an offer, they have a good idea. And plus the funds, we give them a summary of everything. So there's no surprises. This gives them a really good idea of what it is. Okay?
Yeah, the only thing I would add there is keep in mind, like every $400,000 house is not created the same. Whether you're looking one in Austin, in Buda, in Round Rock, they're all going to have different payments because of primarily that tax rate.
Yeah.
Right. I was just driving in and drove by the hills of Bear Creek and it was 1.7 tax rate. Right. Well, that's going to make that a much more attractive payment. But if we're looking on like the east side of Kyle, we're closer to that 3% of tax rate, or what's the the Lazy River complex, Sunfield, right? High tax rate over there. So it really truly depends on where they're looking. And that's why we say like not all houses are created the same. So when y'all find properties and we start looking, we're really going to dive down to get a better payment. This is kind of our generic example here.
I had a quick question.
Yeah, absolutely.
You said DTI. What is that?
Yeah, debt to income. Yeah, and it's a great question. We actually have a slide coming up on it. I think it might be the next one, man. You might have just segued us perfectly. Look at that. Yeah. Cool.
Okay, so debt to income ratio. That is another thing we really, really look at. Okay, and the way that works is we look at their income. Okay, so when they get an application, we get the income. Then we pull from their credit report all the different liabilities they have. It could be credit cards, car loans, student loans. It could be any type of loan they have in there. And we add all that together to come up with the total monthly debts that they have. A lot of the times I'll ask the people, do you have childcare? Do you have something on there? Do you have a property that you own that there is no debts in there? We're always asking to make sure there's no surprises when it comes to debt. So if they have childcare, we have to add that to their debts, okay? But we get all their debts together and come up with that. Then what we have to do is calculate what the future mortgage payment will look like. So this example will be at 1613, would be like their future mortgage payment. We add those together and we divide it by, okay, so here's their gross monthly income, total monthly debts. And we divide it and we come up with a debt to income ratio. Okay, we divide those and it's 45%. So we're always looking at it. The debt to income ratio is really the thing that determines what they qualify for the purchase price. Okay, so if their DTI is, we call it DTI also, their DTI is at 60%, well, they don't qualify. So we'll look at these things and say, hey, let's reduce some of this debt, or let's increase income, or we can lower the purchase price because that'll lower the mortgage payment. So we're always looking at ways to get the DTI to where we need it to be. As
Yeah.
far as, yeah.
Oh, no, sorry, go ahead.
Okay, as far as like FHA, we'll go over the loans, but FHA, the DTI is usually under 56%. With conventional, it's usually under 50%. So a lot of the times if we look at it, and let's say their DTI, like with this 45%, we most likely would go conventional. But if the DTI is at 52%, we'd say, okay, we need to go FHA with that. I'll qualify that way. So DTI is really, really important for us to calculate what that purchase price is. I've had some have DTI at 24%. And I'm like, you can get a higher price house, so there's no stress there. But if they're at 49%, they're very, very close. So we say, okay, the purchase price has to be at this amount, depending on taxes and insurance or whatever, but we don't want you to go any higher in the purchase price.
Yeah,
Right.
and what I would take away from here for y'all is the words debt to income. So if you send us clients and we start shopping and we say, man, their debt ratio is a little high, this is what we're talking about. We're probably shopping over their budget. And also, it's about monthly payments, not necessarily the balances everyone owes, because sometimes people will call us and be like, my goodness, I got $80,000 in student loans. Well, it's all about what that monthly payment is for that student loan. It's not necessarily the balance. And then if we do have an issue where maybe they have too much debt, that's when we'll work with them to say, let's pay off some stuff to reduce the monthly payments. There's a strategy on paying off things,
Right.
because we're always just trying to get that monthly payment lower, not necessarily the overall balance of it. So that's the takeaway there. And
Okay, loan to value. This kind of has to do with how much equity they have in the house. So if they put 3.5% down, they have 96.5 in loan to value. So it's always the loan amount. So depending on how much they put down, divided by what the value of the property is, you come up with the loan to value. So with 60%, that means they have 40% equity in the house. Okay, so we're always, if they put 20% down, it means they have 80% loan to value. That's what the loan to value is. If they put 10% down, they have 90% loan to value. But if it's a complicated one, you just take the loan amount divided by property value, and that will come up with our loan to value.
Yep,
Okay.
and that kind of segues us into the next slide, is the actual loan types. So, what we have listed here are the most common loans that you're going to see and that we use to help get people approved. There are some no down payment options, which are VA and USDA. There are some low down payment options, which are probably the most common loans we use, is the FHA and conventional. And then what I call secondary loans, like if, I would say 90% of the people fall in those first four loans, but if not, maybe we got a chance of looking at this. Not everyone fits inside that box, and we're going to describe that in a little bit in a second. So first, right off the bat, the VA loan. So the VA loan is for veterans only, right? Or, surviving spouses of a veteran, right? You basically have to have some military affiliation and, have earned the VA loan to use it. If we're comparing loans to loans, typically the VA loan is the best loan out there. And it's because they, our servicemen and women earn the right to use that loan, and they should get the best one out there. The highlights of this is 0 down payment. I mean, that's awesome, not having to bring any down payment. The minimum credit score here is at 580. The good thing about VA loans is, yes, you do have to have the right credit score, but their interest rate is a lot more forgiving when you have lower credit scores. 580 gets us in the game, is what I like to say. My goal for everyone is try to get them to 620, but at least we have a conversation at 580. And on that note, if someone applies with us, one of your clients, and say their scores are, below where we need, we don't just turn them away. Like, sorry, you can't buy a home. We give them a plan to try to get their credit score where we can, where we can use it. Linda and I have been in the game long enough to give people advice. Sometimes we can say, do X, Y, and Z, come holler at us in a few months and let's see where it's at. Sometimes people just have like really tough credit situations. Maybe something happened in their life, or, they ran on hard times, and we have to refer them to like a credit repair company. But the main part of that is like, we're always going to give them some sort of plan to get them there. Because I'll tell you, and Linda can attest to this, the people that come to us with like tough credit scores and that truly put the work in and then get to where they need to be and then buy the home, they're the most appreciative people you're ever going to work with. And it truly like recharges the real estate soul when like you get that the people put the work in and you make them homeowners. They're so happy. They never thought they were going to be able to buy a home. So again, we're always going to give your people a plan. Now, we're not in the business of just like reviewing people's credit to review credit, right? If we know they've got tough credit, we may just give them advice up front, but just know that we're always going to give them some sort of like action plan. Linda mentioned debt to income ratio. The good thing about a VA loan, it gives us more flexibility on getting people approved. It gives us, chances to, get people in there if their debt happens to be a little bit higher. Linda mentioned private mortgage insurance. Sometimes it's just referred to as mortgage insurance. That's tomato kind of thing. Another great perk of the VA loan, there is no private mortgage insurance, which makes the payment lower, which helps with our debt to income ratio. So an awesome, perk of this loan. There is a thing called an upfront funding fee. I won't necessarily go into the math of it. That's getting a little deep. But if you're not a disabled vet, then you're going to have what's called a funding fee that the VA charges. It's not us. And this just kind of keeps the program alive for other vets. It helps, keep the program going. The cool thing about the funding fee in this example, it's actually rolled into the loan amount. So it's not a hard cost that our people, clients have to pay for up front. It's just kind of rolled into the loan itself. And the next one is also a 0% down option, a USDA loan. Credit score is a little bit higher. Again, our goal for anyone we work with is 620. We can have that conversation at 580, but it's not always the most attractive. In my opinion, it makes sense to put the little work in to get those 40 points. But it is a 620 loan. The major one when this loan is that your debt ratio requirements are much, much tighter. And also you have to be in what's called a rural area. The government has a map. You can go on to USDA.org. You can look at it, and it has outlines of where you can actually use the loan. So, you're not going to be able to use a USDA loan in like Austin proper, right? And if you look at that map recently, I just did like a couple weeks ago, like anything kind of like close to 35 is not USDA eligible for the most part. Once you start going outwards, then you start getting in the USDA map, so we can start looking at this whatnot. So if you ever have a property or whatnot, we can easily look it up for you. We can even teach you how to look it up if you want to focus on those areas. The mortgage insurance, yes, there's mortgage insurance. It's on there for the life of the loan. We put that word, the life of the loan, because a lot of times maybe USDA is the loan we use to get people into the house to make them homeowners, but later on in life, we may refinance them to a better loan option, which we'll talk about later on. This one does have a funding fee, like we just discussed. As I mentioned, the area itself has to qualify, but also a major one is this loan is income restricted, meaning like if you're making $500,000 a year, the USDA loan wasn't designed for you, right? You can still make up to like $120,000 as a household income and still get approved for this loan, but it is area based, meaning the income limit in Kyle might be different than Lockhart or New Braunfels or wherever. So these are like black and white restrictions that are set forth by the government. So the loan is intended for the people that it was designed for, kind of thing. Great loan if it fits for those people. A lot of times people will see this online and be like, I want that zero down loan, right? Well, let's talk about that and see if you're a good fit. I think the next one, Linda, I'll pass it to you.
All right, FHA. FHA is an awesome loan, especially for first-time home buyers. It's a little bit easier to qualify for. The down payment's 3.5% of the sales price. So that's a really good down payment amount. You can always pay more, so your loan amount's lower, but 3.5% is the minimum you have to put down. Minimum credit score is 580 or higher. We always try and get it to 620. The interest rate's so much better, but we do qualify people for 580. So we just kind of run the numbers and see if we can get it worked. Debt to income ratio max is 56%. So we need it to be below 56%. So conventional compared to that, it's 50%. So it's kind of a little bit better DTI to qualify. Mortgage insurance, they do have mortgage insurance. That's for the life of the loan. Okay. So no matter what, that's just adds to the monthly payment. It's 0.55% of the loan amount right now. If you put 5% or more, it's 0.50%. So That's the mortgage insurance. Upfront fee, they have an upfront funding fee also. It's 1.75% of the loan amount. And they add that into the loan. So it's not something you have to pay at closing. And then loan limits, Travis County, it's $571,550. So that's the maximum loan amount you can have. So if you have somebody that's trying to buy an $800,000 house, they're putting 200 down and it's 600,000, we can't go FHA. We'll have to go conventional with it. Okay, so there is a limit to how much you can have.
Yeah, and each county is different, right? So
Yes.
we'll look that up for y'all and whatnot. This is a very popular loan for first-time home buyers, maybe people with a little bit of challenge credit, and then maybe have a little bit more debts, than the average client we see. But it's a government loan. Like this is this is made by the government. There are some black and white rules with it, but a very, very popular loan, which leads us into our most popular loan.
It's the conventional loan. Down payment, they have, before it was always 5% minimum, but they have like the Home Ready Home Possible loans that allow you 3%, which is less than the FHA, which is 3.5. So it's a great thing to qualify. With those, it's income based. So you have to kind of go in and look at the area that Home Ready or Home Possible is in. It'll tell you how much the limit is for income. And if you are lower than that part, then you could do the 3%. Minimum credit score is 620, so it's a little bit higher than FHA. So if you have like a 600 score, you can't go conventional, or we could try and get that score up. But 620 is minimum. Debt to income ratio, it's usually 50% or less, or below 50%. So it's a little bit stricter than the FHA. Monthly mortgage insurance, it varies with your credit score. So depending on the percentage, but if you put 20% down, which is 80% loan to value, you do not have to have mortgage insurance. And once you get your value, let's say the equity of your house increases after a couple of years and you put more towards principal, once you get to the 80% loan to value, mortgage insurance drops off. Compared to FHA, it stays for the life of the loan. So that's always good. And with FHA, sometimes after a couple of years, if you think you're at 80%, we always say refi into conventional, you could get that mortgage insurance dropped off. Okay. Upfront fee, there is none with conventional. So there is no upfront fee. And then conforming loan limits, I think this has increased to 7.
This might be the 2023 slide edition. We don't
Yeah.
need to update
But
this
they
week's
have the
report.
conforming loan limits in here at 726. And so if you go above that, it means you're a jumbo loan. Okay. So with conventional, they have a certain amount they have for the purchase price or loan limit. And then if you go above that, they consider that more riskier just because it's a higher loan amount. So then we go into the jumbo amount. So a lot of the times if somebody has a house for 800,000, we're like, put more down. That way you don't get to a jumbo. The interest rate's a lot better.
Yeah, and we're not going to cover jumbo loans today. We could spend a whole other class talking about that. Main thing is these loan limits. A couple things I'll add here is I still get these questions all the time, especially from first-time home buyers. Are like, yeah, I'm saving for more down payment because I know I need 20% down, right? Like people still say that. And I don't, maybe they heard that from their parents or their cousin's friend's sister. Who knows where they got that information from? But the main thing is you don't need 20% down to buy a home. If you're a first-time home buyer, and like Linda said, the special programs, we can get you in for 3%. Even if you're not a first-time home buyer, the minimum is 5%. Just, that 20% is really just based on the mortgage insurance alone. So just, just want to drill that into y'all. We don't need 20% to buy a home. The nice thing about conventional loans is the way we get people approved is a little bit more flexibility, I would say, with like certain scenarios and things. Like there are certain guidelines, but with FHA, it's black and white, the rules. Here, you can kind of color in the gray areas, the best way I can describe it to try to get people approved. This by far is the most popular loan. I looked up a stat the other day that like 72% of all mortgages that are done are in conventional financing. So everything else falls into those other categories or like private money or things like that.
I had a quick question.
Absolutely.
PMI and MMI, are they considered
Same
the
thing.
Okay.
Yeah, like technically, like some of them call it private mortgage insurance, others call it mortgage insurance. It's like tomato. It's the exact same thing.
Okay.
Yep.
So talking about that 20% thing, I've heard people want to pay 20% because once you have 20% equity, then the PMI falls off. So you're
Absolutely.
saying 80%? or 20%?
Oh, sorry. So once you basically own 20% of your home,
Okay,
like, so if you went in right away and put a 20% down payment, no mortgage insurance on a conventional. But I'm glad you brought that up because this brings into a scenario. Say someone goes and puts 5% down in the very beginning. Well, a couple years go by, right? They've been making payments, their loan amount's lower, maybe their house is appreciated in value. Linda and I are going to call them and say, hey, we may be able to refinance, or we may be able to do something behind the scenes to get that mortgage insurance to drop off because now you own more of your home. All those other loans we talked about, like, those stay on until you get out of that loan program. And this program, the mortgage insurance can just fall off by a couple different ways without having to refinance. So at least you have the opportunity to lower your payment, and you're rewarded by, paying off your loan and your property value going up. Does that answer that question?
yes. That makes
Awesome.
sense.
Yeah.
Thank you.
I don't know if we have any questions on the web base. I'm not seeing any, but yeah, like I said, this is the most popular loan program out there. The next slide I will take, if I can click to it. Cool. So down payment and closing cost assistance. So, what we talked about just before are like the vehicles to get someone to be a homeowner, right? Like that's how we get there using those loan products. I like to call these like add-ons, right? These are things that we can look at for your clients to see if they, could take advantage of them. And, it's down payment assistance program. I put up there TSHAC. That's an acronym for like Texas State Affordable Housing Corporation. Did I get that right? Yep. So there are multiple down payment assistance programs out there. You may have heard of them. I just chose this one because this is the most popular one. They all kind of work in the same concept. They're basically, it's money that's given to your clients to help meet those down payment requirements. So it's not like they're like avoiding that 3% down payment or 3.5% with FHA. This is going to help them cover that down payment. So if you hear someone saying, I just don't have any money for down payment, or, I'm saving or whatnot, hey, there's opportunities out there that we can look to maybe take advantage of it. Sometimes there are grants, meaning that once the money's given to you, it's yours. You don't have to pay it back. The most popular one right now is like a 3-year lien, meaning as long as you don't touch the loan in 3 years, then that money's given back to you. If for some reason you had to sell the house within like year 1 or 2, all you got to do is, you pay back what you borrowed, kind of thing. But this is to overcome that obstacle of people, needing that down payment. You can get anywhere up to 2 to 5% of the loan amount to help out. So if we had a loan that required a 3% down payment, well, maybe we go get 5%. So that covers all of the down payment and some of their closing costs. There are literally situations where we've had it before where people are bringing $0 to the table. It doesn't happen all the time, but there are ways that we can, try to make that work. There is a 620 credit score limit. They don't accept anything below 620. So, we got to be there. There are certainly income limits, just like the other loan programs we talked about. This is not intended for millionaires or people making $500,000, a year. There are no purchase price limits. It's cool. They do have their own program fees. They charge some fees to kind of keep the programs going and whatnot. And the assistance options change daily. The nice thing that like we talk about on these programs is the rates are the rates, right? So if you call me and you ask me what the down payment rate is, I'm gonna tell you it's so-and-so. If you call Linda, she's gonna tell you the same exact rate. If you call Joe Schmo, the lender down the road, he's gonna tell you the same exact rate because we don't dictate the rates on these programs, the programs do. So again, awesome program. TSHAC is one of our favorites. We are actually preferred lenders with them. You can go to their website and see our names on there. It's my favorite. There are other acronym programs out there that accomplish the same thing. And then there's an FHA 100% financing. It's just a different type of down payment, option or assistance option. It's just strictly for FHA. I don't necessarily need to go into all the details of this. Again, high level overview. There are options and programs out there to help your clients with down payment and closing costs. All right. Let's see. I think I may have a question. Nope. All right, next. So in the beginning of this, in the beginning of this, I mentioned, those four types we talked about, the loan types, VA, USDA, FHA, conventional. If we help 10 people, 9 of them are going to probably use that, maybe even 9.5 of them. But that one little segment of people that just don't fit inside that box, we've got what we call secondary, or they're officially called non-QM loans. QM stands for quality mortgage. It's, I don't know why they call it quality mortgage. This is what it is. But I just want you to know the terms non-QM loans in case you ever it comes across. So these are different options to make people homeowners. I love these products for when they're the right fit. We're not going to start with these routes. We're always going to look at those other options. But if they don't work, then maybe we have this. It's an opportunity to give people a chance. A bank statement loan. So this one is really designed for self-employment people. What you'll learn as you go through your career, and we've certainly learned, is when we deal with small business owners, we'll start talking to them like, oh yeah, I made $200,000 last year, and I'm ready to buy a house. Cool, let's apply. Let's get you pre-approved. We do it. We always ask for tax returns for a business owner. We're going to go through those tax returns. And yeah, maybe they, in theory made 200,000, but maybe they wrote off $170,000 on their tax returns. My parents had a small business. A lot of, parents probably had small business that we're talking to. And, we're not the IRS, right? We don't care how much they write off. Like, that's not our game. But if they start writing stuff off, it's going to affect their income on those first type of loans we talked about. So what's cool here is forget the tax returns. Give me 12 to 24 months of your bank statements. We're going to literally go through each bank statement, look at all your business deposits, and come up with a way to see if we can get the income. I'll give you a real life example. I was working with this guy for 3 years. And for those of that y'all are new in the game, sometimes you get people who want to go out and buy a house next weekend. Sometimes you get people that want to take 3 years to buy a home. This is one of those guys. So we worked together for 3 years. He owned a small business for 20 something years. We looked at his tax returns, and he technically kind of made negative money when we looked at the returns. So we obviously couldn't do that, but this guy is super successful, right? So I did a bank statement loan. And once I analyzed it, I literally was able to give him $35,000 a month in income. On the tax returns, he wasn't getting qualified, but on this, he was. So, we just closed him earlier this month. So that 3-year journey was done. He was super grateful. This made him and his wife able to buy his forever home with this other type of product. So the point of that is, if you have a client and they're talking about, oh yeah, I'm worried about my tax returns or whatnot, and hey, there may be a solution for you. Other option, asset-based lending. This is truly looking at, checking, savings, trust accounts, retirement, and we have a formula that we can use to qualify that for as a monthly income total. So say someone is on a fixed income, right? We got grandma, she's getting Social Security, she's not getting a lot of income coming in monthly the traditional way, but maybe she's sitting on a lot of assets right there. We're not saying we're going to use all those assets to get into the home. We're just using those assets to prove grandma's got some money to help us get to the finish line. Give you another real life example. I was working with one of your agents here, and we started talking, and this lady I was working with, she had just started her own business, right? When people start their own business, we technically need to see a little bit of history there. Can't go start a business in January and want to get qualified in March. It just doesn't work like that. Typically, we need a 2-year history. So, our job is to ask questions. Let's talk about it. Let's see what we can do. And we start talking, and I mentioned this, and she goes, oh, well, I have $1 million trust my parents left me. I'm like, okay, well, now we're talking, right? So, we explained what we could do, and she didn't have to take money out of the trust. We just used that trust to show she's got the capacity to pay this $300,000 loan off. So, just a different way to get people approved. And the last one is called a DSCR loan. It's investment based. This is strictly for investment purposes only. It's not for your primary residence. But what's super cool about this, forget the income. We're not even talking about income, as a personal standpoint. It's what is the mortgage payment? What is the rental income for that house? If they cover each other, we're good. we still got to have the client's credit score. We still need a little bit of down payment, but this is strictly based on what the rental income is. We can even get creative and do the payment at interest only in case maybe the rental income's not there. I had a personal friend who his finances were all over the place. Like it was a mess. And sometimes working for friends is not the easiest conversation to have, but I was able, and he wanted to buy an investment property. And I was able to use this program early last year to get him approved. I mean, he even used Bitcoin as his down payment. Like that's how like flexible these programs are. They don't fit within government guidelines. So there's a lot of flexibility here, but I was able to make him a homeowner, based on this product. So again, if I do 100 loans, maybe 4 or 5 of these will fit in that on a yearly basis. But for who they're developed for, man, they're awesome for those type of clients. So again, just little tidbits for y'all to know about in case this ever comes up with your clients, and that this is our secondary options for this. And we'll pass it back to Linda.
Okay, something that's been really popular are buy downs, and I've had a lot of realtors like they go, what is the mortgage buy down? What's the 3-2-1? What's the 2-1? All that. So we're going to give you a general idea of what that is. There's a calculator you have to do so that it's different for each person actually, because it's based off the loan amount. So if somebody's putting 3.5% down or 5% or 20%, this loan amount may change. But this is kind of the calculator. Now the 3-2-1, okay, so these are the years, okay, and this is a seller has to pay for these. So we're going to base it off the 3-2-1 because that's the example. So what happens is this is a $400,000 loan amount, 7% interest rate, 30-year term. We're doing the 3-2-1 buy down. The monthly payment we calculate is $2,661. Okay, so that's how much it would be with 7%. When we do the 3-2-1, so the first year we actually go down 3%. So that the interest rate is now at 4% instead of 7%. That's a huge, huge savings. And it's going to show it here. Now the monthly payment is $1,909 instead of the $2,606. That's a $751 per month savings. That's huge. Okay, we're going to times it by 12 to come up with this is the yearly of how much savings they will have. The second year, it goes to 5%, okay? So I always let the buyer know, okay, you know that the next year, your interest rate and your mortgage, your monthly payment's gonna go up. So this is what the monthly payment will be. This is how much they're saving compared to the 7%. So it's 513 times 12. So that's 6,167 that they're saving, okay? Then the last year, the third year, it's now at 6%. So as you can tell, it's just increased each percent, okay? So now their monthly payment has gone up to $23.98, which is still a savings from what 7% is. It's $263 savings times 12. It's $3,156 savings for the year. So what happens is the seller has to pay this difference. So you add all these up, and this is how much the seller would have to pay for a $400,000 3-2-1 buy down. Okay, so a lot of sellers may go, no way, I'm not going to, pay that or whatever. You could do a 2-1. So if we did the 2-1, a good example would be it would go to 5%. This is how much savings they would have. This is how much they pay. This is how much they pay for that. So they'd have to pay close to $9,300 for that. So that might be more doable for the seller. So maybe what you could do is ask the seller, hey, can we get $10,000 in seller contributions? You could do the 2-1 buy down and then use the rest for closing costs. But then there's the 1-0 buy down. So that's just the first year. So you'll do 6%. This is how much the monthly difference will be, $263. This is how much the seller would have to pay for the 1-0 buy down. Okay, so there's the different options. As I said, it's slightly different, so you can't have that exact number like, okay, let's just pay $18,000 for the seller, because it may be different. If someone's putting more down, the loan amount may be different. So we have this calculator, so when they're wanting to do it, we will put the numbers in, and this is how much we'll come up with what the seller has to pay for. The seller has to pay for it. So let's say you get seller contributions of $10,000 and you want the 3-2-1 buy down. That means that extra $8,000, the buyer can't pay that extra. The seller has to do the whole thing.
Yeah, and this is fairly new to our world. Maybe we're coming up on 2 years now. It's awesome to help combat the high interest rate market we're in. You're obviously seeing this, how much payment savings is. I bring, and I'm talking about this in a couple different ways. We're technically still in a buyer's market right now, right? Sellers are kind of hurting and wanting to make some deals. So we'll have agents come and be like, hey, I think I'm going to go in and, offer $10,000 less off purchase price. Well, that's cool, right? I mean, and buying it cheaper is always great. But if you took $10,000 off a $400,000 loan, what's that going to do to your payment? Or maybe we use that $10,000 and change your payment by $513 for that first year, right? So it's all about the goals of your client and whatnot. But this is just a different way to kind of like get past that high interest rate conversation. Another great thing that I love about this product is, say this example right here, right? This for, right, exactly this thing's $18,341.76. That's what we negotiated. That's what we got for this client. Well, say in year 2, rates just drop, right? And we're just, rates get better. You would say we're in the 4% range, things are looking good. Well, this client, he's in a 3-1 buy down. You can refinance and get a fixed rate, and whatever you didn't use, like, because we didn't make it all the way year 3, is refunded back to the client. Like, this is money that's just sitting in like an account that's using to help lower the payment. And so it's awesome because that's just something you've already negotiated with. And if we don't make it to year 3, cool, you get all that money back. And so there's really like no like risk here for your buyers. Another way you can do like get lower interest rates, you may heard the terminology of buying a point. So what happens is you come to me and you apply. You got an 800 credit score. We're going to do 5% down. We're going to go for this loan program. I plug it in. I'm like, okay, today's market rate, let's just say is 7%, right? I'm not saying that's what it is today. Just using easy round numbers. Well, say you want to get 6.75. Well, to do that, you have to buy a point. I'm doing quotation marks for the web people out there. And so a point is a hard cost towards your buyer. That's closing costs. That's money you spent. And my theory right now is we are in a higher rate environment. So I'm not a real big fan of buying points and spending hard money, because you may not be in the loan long enough to recoup that payment savings. Because once you spent that money on that point, that's gone. You ain't getting it back. This is a way to at least get a lower payment for a while with no, risk of not getting that money back if you refinance in time. I'll probably say that, and Linda can maybe agree with this, the 2-1 buy down is the most popular right now that we see. In this scenario, it'd have been around $9,000. We just did the 3-1 to just show you how it works, but we can get real creative with it. It's all about, the buyer's goals and what the seller is willing to do. So if you ever come up in a situation where we think the seller has some flexibility, we can have a joint phone call with your clients and talk about, do we really want to go off the purchase price? Do we want to go get some seller credits? Maybe we do a combination of both. Let's figure out how we can structure our offer to, maximize, the benefits for your buyer, kind of thing. That's that. Getting close to the end here. So, what happens after you make the referral? Like, people use the terminology as preferred lender or in-house lender. Yeah, we're in your house right here. I've known Carlin for quite some time. We were on the YMCA board for 10 years. And then some. So, there's a reason we have a relationship, but like we truly treat this as a partnership. Like, we don't expect to just get your referrals because we're in that office right there. We want to earn them. We want to earn your trust. We take what we do very seriously. We really like to be like personal with the clients. Like I mentioned in the very beginning, like this can be a grind. It can get, it can get tough. And like hearing those success stories or seeing people's faces at closing when you close their first house and they've got some kids and they never thought they're gonna be a homeowner, and now they've got a playroom and the kids are so excited to have their own bedroom. That's why we're in this business. Like, we truly help it. You can go online afterwards and Google like statistics. Like, you can look at like education level, college acceptance rates. There's all these studies about making people homeowners, like what it does to their life. Like it enhances it. So I won't go into all that. But the reason I bring this is like, if you send us a referral in less than 24 hours, we're going to make some sort of contact. Connect us by text, connect us by email, do a 3-way call, whatever you want to do. Your clients better than us. We don't care how you get them, in touch with us. But in less than 24 hours, we're going to make some sort of contact. I typically like to start with a phone call. Even if you connect me by text, what I'm going to do is say, hey, let's set up a time to chat. I want to be personal. I want to get to know these people. Like, before I even start talking about loan products, hey, Mr. and Mrs. Client, tell me about yourself. What's going on in your world? Are you in a lease? What kind of house you're looking for? We want to, make this like a personal interaction. But we're going to learn about the goals, answer any initial questions, talk about the process, which the first official step is getting them pre-approved, right? We want to do that for a few reasons. On the client side, definitely want to know if they're even able to buy a house, right? We got to know what they're looking for. We want to be able to give them numbers, programs, an idea, a game plan of what we're working for. But on y'all side, you're going to want to know they're pre-approved. So you're not taking them to 15 houses over the weekend and they're not, they got a 400 credit score. So get your clients pre-approved, save yourself some time, and understand that, we're working with people that are able to buy a home. But also, once you do find that home, the sellers are going to want to see that pre-approval letter from us. And we customize that per offer. So if you go, if we get someone introduced on Monday, you go look at a house on Friday, you want to make an offer on Saturday, call, text me and Linda and say, hey, we found the house. You send us a pre-approval letter. We get you that letter. Maybe we're under contract on Sunday. I mean, that's kind of a dream scenario. It doesn't always work that quickly. But the point is like, let's get them pre-approved so we can get you that letter. While the application is in, we're going to review some financial documents. Typically, that's their income, like whether that's pay stubs, tax returns. We've kind of already covered that. But, we're going to make sure if we're sending them out shopping with you, that like we feel confident in the loan. We don't want to just cross our fingers and hope that they get approved down the road. Because technically how it works is, the mortgage process typically doesn't begin until you're under contract. Then you're going to the underwriter, which we have a class about that later on, but like that's about a 30-day process. It can be quicker if it needs to be, but like it's our job, it's Linda's responsibility, my responsibility as a licensed loan officer to make sure that like they can get to the finish line. We're not going to just send them out shopping, hoping it works out. But we're going to get you pre-approved. Can be as quick as 24 hours. Sometimes people have complicated situations and it may take a little bit longer, but hey, at least we work that out before they go under contract for a home instead of like in it and we find out, oh man, like this is kind of tough. Like we get that all worked out. But our goal is to get them back in touch with you as quickly as possible so they can start shopping. What we always recommend is to start online browsing for homes. Hey, send me 2 or 3 homes that you like. Let's work a real payment. It's one thing for us to just create a generic payment for them. I always find it more beneficial to, find an address, and that way we can like see like, oh, this home in Kyle is priced at here, and I can see the difference of buying in Buda or San Marcos or whatnot. It all makes a difference. But it is a true partnership, right? It takes both of us. It takes y'all as the agents to negotiate the deal, assess the needs, write the contracts. It takes us to get the financial solution done, coming together to make them homeowners. And, we just appreciate any opportunity to work with you and your clients. I said, like, we try to make it, numbers and mortgages. I can't say it's the most exciting thing, but we do try to make it personal. We try to add humor where we can. We try to keep it lighthearted, but it's serious business. Like we're dealing with people's finances. Sometimes people can get like, nervous, excited, emotional. When you start talking about something like this big, like it takes all of us to kind of like, reiterate to the clients, like, hey, we're your financial professionals. We are the professionals in the group. And will you check and see if we have questions?
Yeah, I've been watching.
Okay.
Can I say real quick?
Of course.
Amber sent me a slide to add to this that I'm gonna show them real quick. So, online, if you guys do have any questions, feel free to.
I was trying to figure out how.
The chat right there, it would show a red number.
Okay, cool.
Okay.
I know mortgages. I don't know this.
We're all gonna get to see my email real quick so we can pull up numbers.
And we put our cell phone up here for a reason. Call, text, whatever. Like we don't care how you holler at us. We're accessible. Like I said, obviously we have, lives, and so do y'all too, but we don't mind if you holler at us at any time. If we're busy, we'll get to you when we can, but we do work on the weekends, when we're needed. But is this like a pop quiz slide? Are you gonna test us or?
Totally. No.
Okay.
All right.
Oh,
Let
okay.
me Stop sharing and go back and share that. So Align social media, if you all. Oh, it's not sharing. Here. Come on. All right.
Yeah, I'm glad you did this. There you go.
All right, there we go. Align social media. So please follow, like, share. I don't know what else she wants me to say about it. She'll just show you
Spin a
the slide.
sign outside with
Right,
QR codes.
Right,
Yeah.
yeah. So feel free to follow. And we will occasionally, like, we'll do videos on there and things that you guys can share. Travis does Market Minute.
Yeah, so on my personal Instagram and Facebook, I do this thing called like a mortgage minute. I just try to give you a little bit of knowledge. Well, we'll talk maybe about what an appraisal is or what PMI is. It's for your content, it's for you to share to your clients. I highly suggest if you want to use us for some of your social media, if you want to make a video for your people, we are open to doing anything you want to talk about. We're doing loan applications for you, but we're also here to help you generate more business. I am very well aware that this is a referral-based business. You get referrals from your sphere of influence. Typically, we get referrals from our sphere of influence, but we also know that we're very grateful for your referrals. Like I mentioned, typically it starts with y'all. So yeah, we're your loan officers and we're here to get your people approved, but anything we can do to help build your business. I mean, Keisha even got me to do a TikTok one time with voiceover. I don't know how well it went, but if you want us to be a part of anything we can do to help grow your business, whether it's seminars, if we want to do a first-time home buyer thing, with enough notice, we can make it happen. Our other loan officer, Tyler, he is taking a rare day off in Disney World with his family. He's really good at those seminars. So we're all kind of three different individuals with three different personalities. So I feel between the three of us, we kind of fit a wide range of people to get, there. If you have someone who's into pickleball, well, maybe they're for Linda. You got someone who's got long hair, well, maybe they're in for me. So I'm actually cutting it in about a month. That's a whole other story. But yeah, so yeah, that's us. That's our presentation. I mean, if y'all have any questions, scenarios, an individual, thing with a client you're working with right now, we're here. They'll fire away.
Thanks, guys. I'm gonna let you go online. Bye.